Warren Buffett, 94, is about to speak at the Berkshire meeting. Known as the godfather of value investing, he's challenging market consensus with contradictory moves, selling S&P 50 index ETF, claiming permanent U.S. investment, hoarding $342 billion cash, and increasing a $40 billion stake in Occidental Oil. Behind this split is a cognitive shift about global wealth's future. Buffett's American beliefs evolved from static long positions to selective harvesting. Unite a little red heart from all four corners to the start. The truth that cash is king is actually planned. 60 years of crisis warnings by outsiders seem the most extreme in money hoarding history. It's about moving from safety margins to survival instincts. Burke Hill's cash reserves rose from 203 years of 100 years to survival's starting point. Berkshire's cash reserves soared from $167 billion in 203 to $342 billion in 204. Hoarding $4.6 billion daily, faster than ever before. 208 years before the crisis, only $40 billion, $350 billion before the internet bubble burst. Warren Buffett accumulates cash through a triple sell-off of Apple. Many tech stocks' green positions have been sold in successive bids to sell U.S. stocks, similar to the stance of green positions in airline stocks during the early 2020 mask days. History shows when Berkshire's cash reserve ratio surpasses 20%, it often signals systemic risk. 2%. 8 years before the financial crisis, 19%. Current cash to total assets, 24% has triggered a red alert based on the S&P 50 index. Shiller PE ratio, now at 35 times. By issuing 1.3 trillion yen in bonds, surpassing pre-depression levels, Buffett warned liquidity could vanish when the music stopped. The second message of the long S&P ETF is the selective abandonment of U.S. assets due to index funds' valuation distortions and leverage traps. In the fourth quarter of 24, Buffett took a 6-year long position in the S&P 50 ETF. This occurred when the S&P 50's adaptive rate hit a factor of 28, indicating his belief that passive investing had turned into capital bubbles. The largest tech stocks, like Apple and Microsoft, which made up only 30% of the S&P 50's weight, contributed 8 times the annual index gain. The 4-year index rose by 87%, followed by the U.S. economy's collapsing codes, tariffs, debt, and currency issues after Trump introduced a reciprocal tariff policy on April 2nd, causing the average U.S. tariff rate to soar. It's anticipated to slow GDP growth in the 205th year by 1 to 2 percentage points and raise inflation by 1 to 2 points. The Fed's balance sheet hits a record high, and the money supply surge has caused a confidence crisis in the U.S. dollar. Third, the timeless U.S. investing rule is to shift from local assets to global gains, and Japanese firms are now Buffett's new moat with the issuance of 1.3 trillion yen bonds. By investing in 5% of the 5 largest trading companies with dividend yields, he has created a negative cost of capital, plus exchange rate arbitrage, plus a chain of control triangle model, a triangular model, and he controls 20% of the world's liquefied natural gas trade. Occidental is a major bet on energy dominance. Despite a $40 billion loss, Warren Buffett secured an 8% dividend yearly through preferred stock. With 28% shares, he controls 15% of shale production in Iteration 2 Basin. Berkshire would control 7% of U.S. crude oil production, similar to his strategy with the 1967 National Insurance acquisition to build the FDIC empire. The unity behind the fourth contradiction shows the new capitalist survival code, from value investing to systemic parasitism. Warren Buffett's actions reveal a harsh truth. Traditional value investing can't survive market distortions. His new strategy is to leverage sovereign credit, use the BOJ's ICC policy to secure welfare rates, finance and control infrastructure, and dominate the real economy's lifeblood through merchant banks, railroads, and the energy network. Create a liquidity black hole, accumulate cash reserves, and wait patiently for a market downturn to make your move. For the typical investor, when faced with Warren Buffett's vast network of super sovereign capital, retail investors need to focus on 3 key actions. First, be cautious of the index illusion that the perpetual rise of the S&P 50 is driven by the monetization of U.S. debt. Second, focus on acquiring tangible assets and ensure proper asset allocation. Third, construct a resilient and diversified portfolio to mitigate risks when the market shifts. As the market shifts, the financial ark that Warren Buffett, with his $344 billion in cash, has built since his youth, no longer serves as a safe haven for the average investor. His seemingly contradictory moves of investing in S&P ETFs while increasing his stake in Japanese stocks are actually a sign of the top players breaking away from the old norms. The true insight from the shareholders' meeting was that the long-standing strategy of investing in the United States forever had quietly shifted to a strategy of global profit maximization. When Trump's tariffs align with the Fed's money printing, the only way to understand Warren Buffett's seemingly contradictory strategies is to see through to the underlying truth, the algorithm of survival. It's the only way to defend in this wealth shuffle.